Hi everyone, this is Bill, and welcome back to our emerging channel, and thank you for joining us today. Although we throw in some college football coverage, here on the channel, I mainly cover investing, both in residential real estate and in the stock market. Today, after a rough week, we're going to discuss the stock market. It has been a very rough period for stock market investors over the last couple of weeks, and this past week was just brutal. If you're like me, your portfolio has taken a substantial hit. While I am down somewhere in the 25% range, that range will certainly vary for each of you depending upon the makeup of your portfolio. The more speculative stocks that make up your portfolio, the further down you may be. Among my top holdings are generally the low beta stocks of Coca-Cola, Walt Disney, and Class B shares of Berkshire Hathaway, which I consider to be core portfolio stocks. They held up fairly well, or I would have had a more severe downdraft. What in the world was going on? Can we pinpoint to a catalyst that would trigger the downdraft? Well, let me give you some thoughts. Before we move on, could I pause briefly and ask you to consider liking the video and subscribing to our page? We're trying to get going here, and it would be most helpful for us. Thank you. Now let me state that in my opinion, I do not think what we have been through is a market crash. Now I made a video on the moves I would be making in a stock market crash, which I'll link to down below in the description. But I think this is just a correction that is really a kind of a healthy action, although it sure doesn't feel like it. One of the catalysts for the market falling was simply the fact that the overall market was extended. Let's take a look at the S&P 500 on a chart from TradingView.com. We can see the S&P 500 has been in an ascending channel for some time. On two occasions, the S&P broke a support level in late 2019 and then when the pandemic struck in March of 2020. Both times, it worked itself back into the channel. But if you look at October 2020, you will see that the S&P broke above the resistance level, which is the high bar of the channel, at about the 3,600 level, to race up toward 4,000. The top of the channel now becomes a new support level, and the S&P could fall back to that level at about 3,685 without violating anything technically. So there we can see that the S&P was just simply extended. Again, on a chart from TradingView.com, let's check out Apple, a widely held stock. Like the S&P, Apple has been in a similar ascending channel. Apple broke through its resistance level of the channel at just over $90 per share in the summer of 2020. After a stunning rise to almost $150, Apple has been retracing and is now at about $120. There's an area between $110 and $120 where Apple spent some time wrestling in. So this is a level we could see Apple using as a new support level, again, without really violating anything technically. So we can see that Apple was also extended and just engaging in some normal, if uncomfortable, price action. We can potentially see a new channel forming for Apple with a current support level at about 115 and a resistance level at about 138 currently. After all, Apple just crossed $100 in August. But I doubt that is the main culprit for the pullback. A story from CNBC offers us a new clue, which gives thought another reason could be that interest rates were threatening to rise quickly. Rising interest rates make the cost of business higher for most companies, particularly those who are losing money and have weak balance sheets. These types of companies are sometimes housed, among other areas, in biotechs and in some of the SPACs we have all been jumping in. No worries, I own several of them. This is just the playing fields that we are currently on. While rising rates are certainly on the mind of investors, the velocity of this recent movement seemingly spooked investors with a dose of uncertainty, which is not a good thing when forecasting future performance. Is there more? I think so, and I will offer you a controversial thought. I think the powers that be, or the suits, are not happy with the independence being exhibited by mom and pop investors. The emergence of Bitcoin seemingly creates issue for them as it diminishes their ability to govern and control monetary usage and policy. While some are begrudgingly becoming engaged with blockchain, Bitcoin, and the entire crypto ecosystem, the media joins most old-school investment firms in looking at the ecosystem in a condescending fashion. The Reddit-fueled GameStop situation also seemingly irked the powers that be, and in an incredible dose of arrogance, rules were changed in midstream to protect the big guys. They lost control, and they don't like it one little bit. Several YouTubers with vast audiences are coming under fire recently. And then lately, as the downdraft hit many high-flying stocks such as Tesla and stocks in many emerging areas like genomics, 3D printing, and AI, the stocks that the team over at ARK Invest are heavily invested in, I noticed many starting to take aim at Cathie Wood. That includes Jim Cramer on CNBC. Jason Raznick of the awesome Benzinga.com asked Kathy about the comments Cramer made. Check it out.
I'm out of Kathy Wood. Close your fund. Close it. Listen to what the late Jack Bogle would say. Close it. Concentrate on performance, not on trying to deploy capital. It's okay. It's nose in.
Well, he's talking about the ETFs. It is not possible to close an ETF. It's just not possible. I think he's referring to the mutual fund industry, and that's not what we are.
It seems by the end of the week, most everyone was selling just to sell. What is a thesis where you like a company at $130 a share and it's toxic 2 weeks later at $66 a share? Who knows? Although I had limited dry powder, I added where I could on Friday. I added to INMD, a company I highlighted in a video last week, which I will link in the description. INMD has increasing sales and has shown very strong relative strength. I did a video a few weeks back. I will link in the description about my thoughts on bank disruption. So I added to IPOE, which is SoFi. Then I added to CRISPR Therapeutics. Let's take a quick look at a chart of CRISPR. As a leader in the genomic space, I think CRISPR Therapeutics is about to really revolutionize healthcare. But it has been performing very poorly since breaking support of an ascending channel in February. The stock appears to have found support, however, around $110, where it had many touch points before breaking out in late November of 2020. The last 2 days have seen heavy volume in CRISPR, but if you notice, the stock appears to have placed a line in the sand. To me, I think buyers were coming in, particularly on Friday. I own CRISPR as a long-term hold, but see it rising on the short term based on Friday's action, pending market cooperation. Is the selling in the market finally over? Folks, I don't know what I'm having for lunch tomorrow, but I think we are at or very close to the end of this downdraft, particularly with the stimulus bill passing. I'm not a fan of stimulus, but right now the market is, and that's all that really counts. Of course, please be advised that I'm not a licensed financial advisor. I'm not recommending any action on your part. I'm just informing you of my thoughts. Please do your own due diligence and find out if any of my thoughts and actions might benefit you. The landscape of my financial platform is no doubt different than yours, so what I may be doing may not be wise for you to do. As we conclude, please help us out by liking our video and subscribing to our page. We sure would appreciate it. Thank you so very much for watching, and we'll see you next time.